What's a tax deduction that you get while you're employed that you're actually going to lose once you retire? If you've ever wondered about taxes in retirement, then stay tuned for this episode of the FERS Federal Fact Check. Today we have a question from Charles, and it's really hitting on several things, not only eligibility, retirement, gross versus net, and taxes in retirement. So let's go through this and listen to his question, then kind of dial it down for some good information about your federal benefits. I'm aware that after I put in 10 years of federal civilian creditable service and then retire, my FERS annuity will be reduced monthly by 10% for surviving spouse, 50%, and the FEHB premiums will be deducted as well. My question, are the FEHB premiums in retirement deductible? Is the 10% deduction taxable? What is the monthly amount I should use as the gross received prior to the simplified method deduction? Is that the total annuity? The annuity minus FEHB and the 10% reduction example, thanks. What he's talking about there, and thank you so much, Charles, for the question, the simplified method deduction is something that they talk about in regards to calculating how much of your pension is going to be taxable at retirement. Don't worry, the IRS has a whole pub on it, which slightly overcomplicates it. We're going to dial that down, hopefully make it a little bit easier to understand. So, Charles, you had a lot of great questions in there. Let's kind of break this down. One of the comments you made at the front is you understand that once you have 10 years of federal service, you can retire and your spouse is eligible for retirement benefits and you get health insurance. Possibly, right? But we got to think about what are those rules. In order to keep your health insurance for retirement, you must retire with the eligibility of an immediate pension. That's the requirement that's going to be there, is the eligibility of an immediate pension. So what are those rules? We got a couple of them that are going to be here. One, you have your MRA, which is your minimum retirement age based on the year you were born. You got to have a certain age before you can retire. Minimum retirement age and 30 years of federal service. This is our age component. This is our years of service component. That's there. Or if you're not going to meet that, you could be age 60 and have 20 years of federal service. And if you're not going to meet that, you could be age 62, of course 60 or older, right? And have at least 5 years of creditable service. Now, if you're not going to meet any of those rules, there's some certain early out opportunities which are also there. They do come with a penalty. And you can be MRA, minimum retirement age, and have at least 10 years of creditable service, and you are eligible for an early retirement as long as you've hit that MRA and 10 years of federal service. It does come with a steep penalty if you go under this option. The penalty is 5% per year every year we're under the age of 62. So if I'm 57 and I have 10 years of service and I separate, 62 minus 57 is 5 years times a 5% per year penalty. That's a 25% permanent penalty that never goes away from my pension. So sometimes this is an option people want to do, but understand how it works. So number one, it's not so much a 10-year requirement, it's an age requirement that's going to be there. If you're just looking at 10 years, you at least got to meet your minimum retirement age, then you might have a penalty in your retirement. If you were 62 with 10 years of federal service, boom, you could absolutely retire and there's no penalty in your retirement, which is great. So understanding these rules is really, really important. Also understanding that every federal employee is slightly different. So when you're talking to someone else and they're like, hey, I only need 10 years to retire, that may not be you. They may be retiring when they're 62 years young, and they only need 10 years of service, right? They only need 5. 10 is going to get them. Maybe you want to retire when you're 60. Well, at 60, 10 years isn't going to cut it for you unless you take a really penalized retirement. So understand these rules and how they're going to work. So that's the eligibility rules that are there. Let's also talk about how your gross versus net question, which I just thought was outstanding, and how that's going to work in retirement. So the first thing is you have your gross pension that's going to be there. Now I'm going to use round numbers here just to make my math easy. And let's say after 10 years of federal service, your gross pension was $1,000 a month coming in. It's 1% for every year you worked. So 10 years, let's say your high three is 100 grand. Okay, your high three is $120,000 a year. 10% of that is $12,000 a year. Divided by 12, then you get $1,000 a month in income. Just quick math here. So the question is, great, what do we care about, the gross or the net? we care about the net. So what's the first deduction that's going to come out? And he already mentioned it, which is survivor benefits, and that cost about 10%. So you're going to have a $100 reduction, which is going to come out. So that's now going to leave us $900. Then you're going to have some deductions that can come out of here. What is that? FEHB, life insurance. Example could come out of here. You could have taxes, which are going to come out of here. Those are all deductions that are going to come out of your pay. Why is this terminology important? Well, let's say your FEHB premium is $500 a month. That's pretty reasonable, right? It's probably on the low side. Let's say you're paying $100 a month in order for your life insurance. And so the question is, great, how much should you have taxes withheld? Well, this question first is, what's taxable? And Charles, you brought that up. Any reductions that you have, which would be a penalty or survivor benefits, comes out pre-tax. So this $900 is your taxable income for retirement. This is what's going to get kicked in. Then you have deductions that are going to come out. Let's just leave taxes off for just a second. Your $900 minus 5 is $400, minus 1 is $300. Now without a tax payment, you're only getting $300 a month out of your $1,000 a month pension. What do we care about? The gross or the net? We care about the net because that's what's going to hit your bank account. In retirement, we do not get to deduct our health insurance premiums. While you're working, you absolutely do, which is a great benefit. It's a great benefit to keep FEHB, federal employee health benefits, into retirement. We just lose the ability to deduct them. So knowing this is really important so we can look and say, great, let's plan on paying taxes on $900 a month. Now, Charles, you implied inside of there something called the Simplified Method in order, because not all of this $900 is subject to taxes, because while you were working, some of your pay was withheld to pay for your pension, and it was withheld with after-tax dollars. So not all of that is. When I'm working with clients, I assume 99% of this is going to be subject to taxes, and guess what? I get really close on my tax projections. So assume 100%, 99% of this is taxable. You're going to be really close as it comes down. Couple of great action items from this. Number one, understand the rules of retirement that we went through. When are you eligible to retire and how much are you going to get? Understand the difference in gross versus net, and understand how much is going to be subject to income taxes. If you've had questions about this or need help putting this together to say, great, how does this apply to my personal information? Mike, these videos are great. It gives me some information, but man, I've got a lot of moving parts in my own personal life. What do I do with that? Well, good news, that's why we're here. If you would like help with that, I'd be happy to chat with you, or one of our financial planners on our team can chat with you, and we can sit down and walk through what are the steps for a successful retirement. And if you just have a question, go ahead and submit it, and you might be featured on the next FERS Federal Fact Check. Until then, happy planning.